What would you say a good first step would be to go, I guess, just to begin the journey into commercial real estate?
First thing I would do is private markets, it's really hard for an investor to get access to them. Even if they have, let's say, tens of millions, you need hundreds of millions or billions.
The barrier is really just taking action. Those that take action get rewarded.
You don't have to necessarily own something immediately to get experience and learn how to actually own it.
Different investors have different objectives and different requirements, even if it's the same property.
Hey, what's going on, everybody? We got another episode coming at you. We got Cameron Hastings, a partner at Selene Bright House. He is a real estate investor, and it was pretty cool. He had a podcast schedule reach out to us, so one of the first that we've had for that, and that really excites us. It means we're getting out there. And for those of you that are also starting a podcast, just keep going. Just keep putting out episodes, talking to people. It's going to come. So, Cameron, I appreciate you taking the time to join us today to talk about retail centers and your story.
Of course. It's great to meet you guys. Thanks so much for having me.
Yeah. Absolutely. So for the people who don't know you, give us a little bit of your background and then how you got into commercial real estate.
Sure. So I started my career as an architect. I went to architecture school and then moved immediately to New York, where I live now. And while I was an architect, I designed primarily high-rise office buildings, both renovations of existing buildings as well as ground-up projects in New York, LA, and DC. And those were both for owner-occupiers who were building their own headquarters or other regional offices, as well as REITs and institutional investors who own those properties for investment purposes. But particularly when I was working with the REITs and the developers, I realized that I was really more interested in what they were doing than what I was doing. That as an architect, I didn't have as much autonomy or control over the projects as I wanted to. And I also realized that the business model wasn't as good as the owning and operating real estate, that you didn't have the recurring revenue. You didn't have the long-term relationship with your investment or your project. So decided to go back to school, got my master's in real estate development, and started working as a multifamily developer first. So while I was in that role, I built a 150-unit apartment building in Jersey City, which is just across the river from Manhattan, as well as helped that owner refinance their whole portfolio. This was in 2020, so interest rates had just fallen to zero, basically. So it was a good time to take everything that they'd financed and see if we could refinance it for a lower rate, as well as sell off some of their legacy assets. So they had started with duplexes and smaller buildings, 6 to 8 unit buildings, and we're moving up to these more Class A, larger scale apartment buildings. So helped them sell off their legacy assets as well to kind of improve the average quality of their portfolio. And then from there, I went on to become a real estate consultant at Newmark, where I was a managing director focused on portfolio strategy. And in that role, I worked with similar types of clients that I worked with when I was an architect. So REITs and institutional investors, as well as owner occupiers, but across a much wider geographic focus and property type focus. So we worked with clients around the world, primarily in North America, but some in Asia, some in Europe as well. And in that role, I got to see really a wide range of property types, from more traditional property types like logistics or retail centers to more specialized things like data centers or electric vehicle manufacturing, particularly the battery plants. So got to better understand how those investors, those operators were thinking about those different properties, different markets, and primarily how to think about a collection of buildings as a portfolio rather than just individual assets, and how that can work in an investor's favor in terms of diversification and in terms of just the different cycles that all these properties operate on. We tend to think of real estate, and particularly in the media, as this homogenous thing, but really it's dozens of different property types if you really get down to it, especially if you subdivide the retail and the multifamily into its different components. There's like thousands of different combinations that you could make between investment vehicles, property types, strategies, and where you are in the capital stack. And now I'm an investment advisor, so I work with both individuals as well as companies, and focus on real estate, digital infrastructure, and I'm a partner at Selene Bright House, where we focus on unanchored strip centers, particularly in Southern California and Dallas-Fort Worth.
Awesome. That's cool. So you've had a very, sounds like a very I don't know the right word, healthy and just, pretty deep understanding of real estate across all the different paths you came through. That's really cool. Really interesting. So I'm curious, what made you go from architect? Obviously you wanted to get into commercial real estate and then going on to eventually starting your own firm. Was it just you wanted the ownership in that and you wanted to be more of an entrepreneur, not as much of an employee, or was it just getting after specific asset types, or what made you make that switch?
I'd always wanted to work for myself or to have more control over my own path. Anytime I was an employee and I kind of looked 10 years ahead of me or 20 years ahead of me about, okay, what is this guy's life like? What is my boss's life like? It wasn't really something I wanted. I wanted more control over what my future was going to be like and be able to have more autonomy over those investment decisions or other things. So that's really what drove it. And the shift from architecture and consulting into actual equity ownership and properties is part of what I mentioned. I just think it's a better business model that you can have a long-term relationship with these properties. Part of what I like so much about real estate is you can have a property that's 200 years old and it's still making money, whereas there's not very many companies that are that old that are still producing or still operating.
No, that's a great point.
Yeah. I just think it's cool to I just want to bring this up, how in commercial real estate, you get to talk to so many different types of people. In my network, I haven't talked to a lot of people on the institutional side coming from REITs and coming from, like, my sister is a architect and study in architecture, and she works with some commercial real estate firms and stuff like that, but really haven't even gotten to that side and talked to that kind of person before. So that's really cool. And you seem pretty young, pretty successful start to your career and stuff, and I wanted to applaud you for that. That's really cool to be a partner already. Curious of why you guys chose unanchored retail centers and why Southern California and why Texas.
Sure. So a couple of reasons. One is that we were looking for a property type that hadn't had the same kind of institutional adoption that some others had, but was beginning to. So we could see a clear pathway that this was going to become more of a core traditional property type in the way that we saw single family rentals or self-storage over the last 20 years go from something that was really a mom and pop business to something that now we have REITs that are tens of billions of dollars worth of these properties. That is just starting to happen in unanchored strip centers. Right now, still about 90 to 95% are owned by individuals and families, where they maybe own 1 to 3 of them, but they're not large scale owners. The first REIT just went public as a spinoff from Site Centers in October. So there is one publicly traded investment vehicle that's focusing on this, but it's kind of a new niche that hasn't been as exposed to institutional investment, which tends to bring the cap rates down and make the market just much more competitive overall. So the focus on that is partially based on the fragmentation of the industry. It's partially based on what we saw during the pandemic and the last few years in terms of a pressure test to see how these centers did. And they did very well. They're essentially full. Occupancy across the country is about 95%. And part of that is that they're much more focused on necessity purchases rather than discretionary purchases. So that's how they really differ from a mall or a power center, where you're going to buy something that you want but you don't need. Whereas these strip centers typically is things that you need or that you're going to on a regular basis. So maybe you could go there multiple times a week, even if it's a laundromat is there, there's a coffee shop there. And then the work from home trends also really pushed increased foot traffic to those centers as people are working from home. And this is now the convenient option. It used to be that you would be downtown in whatever city you work in, have lunch there, get your dry cleaning done there, whatever it is. But if you're working from home now, it makes a lot more sense to just go down the block to your neighborhood strip center, and you can generally do whatever you could have done previously. So those are the reasons for the focus on the property type. Is we see an opportunity there because the fragmentation, the stability of the property based on the industries that are focused on it. And the market focus is twofold. One, those are our home markets. So one of my partners is based in Southern California. She's been in real estate for about 40 years and started her career in shopping centers in Southern California. So she has a long history of both being an employee with other real estate companies as well as being a developer herself. She's developed single family communities and hotels throughout the area and is now turning kind of back to strip centers, which is where she started her career. And then we have another partner partner in Dallas, she's more focused on our investor education program and our investor relations program, but has always lived in Dallas for the last, I guess, 40 years as well. So has deep experience in that market. And but beyond that, the focus on the two markets is that they're kind of complementary to each other in a way, that oftentimes when California loses, it's to Texas's gain. A lot of companies and people are move between the markets, but it goes the other way too. People are moved from Texas to Southern California based on similar climates and industries and all that. But then there's also different opportunities. DFW tends to have much higher cap rates. So the initial yield that you're going in with is much more favorable. Whereas in California, cap rates are much lower, but it means that if we can improve the cap rate, or if we can improve the NOI, it makes a bigger difference to the ultimate value than it does in Southern California. So the strategy is the same, but the dynamics are a little bit different.
Yeah, no,
for
certainly.
sure.
The company we work for, City Plat, they're buying similar thing. They do small bay retail and then also unanchored neighborhood strip centers. And I think the reasoning behind them is very attractive. It's, people call them Amazon proof because you've got stuff like a pizza restaurant, maybe a Chinese restaurant, a nail salon, a barbershop, things that you can't go get on Amazon. And just like you said, food, just stuff that you can't go order on Amazon, basically. So I think there's a good argument to invest in small strip centers, and we would potentially look at that. Jesse and I just purchased a couple warehouses, but retail definitely is not out of the picture.
Yeah, for sure. And I think you made the perfect pitch for why unanchored is so much better than anchored tenant retail, because you hit all the pluses. The negative on the opposite side is, okay, I've got a food line here, but what if food line goes dark? And you're going to probably lose all of the tenants in it. It's very rare that I've ever seen an anchored tenant retail center lose the anchor and the rest of the places survive. I can only think of one, and it was very remote, and it's because of that they succeeded. But you have, with that, since the pandemic, people want to go not very far from their house. A lot of people work hybrid now, so it's just like the whole climate is changed, and it's interesting to see that happen across the country. Question I was going to ask you. Oh, go ahead, Graham.
No, you go ahead. Okay.
One of the questions I was going to ask you was the primary differences between the private and public real estate markets, and how investors can leverage both for optional, portfolio diversification.
Sure. So part of what I talk to clients about is how to create a real estate portfolio that includes both. And there's different reasons to focus on different property types and different vehicles. I actually just gave a presentation to a group of women just before this on this very topic. So when we think about investing through the public markets, it's a lot about getting access to property types that may be difficult to get access to through the private markets, either because you just need so much capital to get into them. So things like a casino, which may be several $1 billion for one property, or things like data centers, both of which also have a lot of regulatory barriers to entry, as well as just space and environmental barriers to entry. Data centers are an example where we just don't produce enough power right now in a lot of markets to build more of these data centers, even though there's huge demand for them. So in the private markets, it's really hard for an investor to get access to them. Even if they have, let's say, tens of millions, you need hundreds of millions or billions. But through the private or through the public markets, you can invest in a REIT that owns these data centers and get access to them. So it can be part of getting access to more niche property types or more specialized, harder to access property types. But it can also be about kind of portfolio completion strategy. So in the private market, maybe like you guys, we own industrial properties and retail properties through either direct ownership or maybe through a fund. But then we can also add in some of these more specialized property types to even out returns, get exposure to those property types, and also get exposure to international markets that are much harder to get access to if you're based in the US, to either invest with a sponsor there or certainly to buy your own properties in another country. So for all those reasons, using both of those different kind of vehicles can really make sense for retail investors or even institutional investors. Both groups use that strategy of both listed and private real estate.
Yeah, no, that's really good. So the bulk of our audience is either beginners or somebody who's wanting to transition from residential to commercial. Do you think that unanchored retail strip centers is a good place to start, or what would you recommend for somebody just getting started, like kind of asset class, and what would you tell them to go do?
So yeah, I think that especially if someone has already owned a a residential property. Going to commercial in some ways can be easier. The management responsibilities are significantly less, especially if it's a single tenant property. The risk return there is a little bit different if you're buying a single tenant industrial or a single tenant retail property. It's all concentrated on that one tenant. You don't have all of your apartments or all of your single family housing to rely on. So if that space goes dark, it's, you've lost 100% of your income in that investment. So looking at properties that have more spaces, but still is something that you would be able to manage yourself. I think unanchored strip centers can be a good solution to that, where you have maybe 10 to 20 units. So the risk is spread across those different tenants and those different units, but you don't have the same kind of monthly management responsibilities that you do with an apartment building that might be the same size and the same value. I think that also one of the huge benefits of commercial real estate versus residential real estate is the lease structures, which I'm sure you talk about with other people. But having a triple net lease structure versus a gross structure where your tenants are ultimately responsible for operating expenses and some of the repairs and maintenance. Sometimes you even have an absolute triple net where they're actually responsible for the structure itself, can take a lot of the management responsibilities or all of the management responsibilities away from the landlord, which can really work in an early investor's favor, especially if they don't have a team around them to help them.
Yeah, no, that makes a lot of sense. What would you say like a good first step would be to go, I guess, just to begin the journey into commercial real estate? Because that's obviously it's pretty intimidating for people just getting started, and you've been through a lot, and also you said you're kind of in an advisory role. So I'd be curious to hear what you typically recommend somebody like they're just brand new. What do you typically tell somebody to do to get into it?
The first thing that I would tell people that are brand new to real estate, have never invested in real estate before, is not actually to go out and buy your own property first. The first thing I would do is invest with a sponsor in your market. So find a firm like yours, if you're based in North Carolina, that has experience and has a team around it, so that you can get exposure to these real estate investments, but you don't have the same kind of management responsibility. And through that initial investment, you can learn about how it works. You can talk to you all or to whatever sponsor they're working with, so they can understand the dynamics of that investment without the same level of risk. And then maybe once they've done that first investment, so either through a fund or a syndication, they can move on to maybe a joint venture. So I still wouldn't say go out and buy your own property yourself. Find someone that maybe was another investor in whatever vehicle you just invested in, is someone in the market that has experience that's willing to partner with you, so that you can split some of those responsibilities. Maybe that person is responsible for the actual property management and you're responsible for finding investors to bring in. Maybe it's the other way around. But if you can kind of ease into it so that you're learning along the way and you're not taking so much risk in the very beginning, I think that makes the most sense for investors that are just getting started with commercial real estate.
Yeah, definitely. I couldn't agree more.
We talk about it multiple times. We even did an example of our deals and how, you could be GP, you could be an LP. There's so many different ways to get into it. I think the barrier is really just taking action. And those that take action get rewarded, no matter how, they decide to take down commercial real estate. I wanted to ask you, like, your first deal, what happened for you? How did you take down your first deal?
Mm-hmm. So my very first deal was when I was still working as an architect, and I decided to start flipping houses. So that was kind of a low barrier to entry, fairly inexpensive first type of property I could get into, and something that I could do, on nights and weekends after work. So it didn't take the same amount of responsibility as managing a larger property. And that's how I first got into it. I later kind of figured out that I was competing with contractors and people who were doing the work themselves, and it was hard to compete on price with that. With someone who was the owner themselves was on the roof hammering shingles in, and I was paying a contractor to do those kind of things. So it's another reason for early stage investors to maybe not do that, maybe to look for that more experienced investor that they can invest alongside rather than trying to do it themselves. And then beyond that, the later deals were generally with partners, were with either more with clients that I got some equity in the projects that we were investing in, or as an advisor where I didn't actually own the property, but I got some kind of exposure to it through fees. So that's another ways that you can kind of have synthetic exposure to some of these if you do a service for whoever owns that property.
Yeah, that's a great point. We, Jesse and I are both commercial real estate brokers by trade, like by day. That's what we're doing. And that's another great way to get into it. Like you said, you can, whatever it may be, whether it's property management management or commercial real estate brokerage, or even if you're just working as an intern at some kind of firm like yours or somebody else's, you don't have to necessarily own something immediately to get experience and learn how to actually own it. That's a lot of what me and Jesse did. We joined CityPlat. I joined CityPlat about 2 years ago, being a broker, seeing what they were doing in the market, and I wanted to learn that side of the business. So I was able to do that. And just in 2 years, learned so much without owning a single property. I learned how they bought the property, how they financed it, how they manage it, everything. I still have a lot to learn, but I learned a tremendous amount just by kind of, like you said, just like not being the actual owner.
And if early on in your career, you can do things like that, like brokerage, where you get to see a lot of different properties and a lot of different clients and learn about how they think about their properties, rather than say, if you want your first project to be a development project, for example, it's going to be years before that property's up and running. And your exposure is really just going to be in that property. It's a lot of work, and you're not going to see the full breadth of what you could do. So I think early stage people, as much as you can learn and see from other people by working with other clients or finding partners or finding people to learn with. One of the things that we do at Selene Bright House that I mentioned is an education program. And we invite women to come to our webinars, and we'll start having live events as well, where we both ourselves give presentations as well as invite other kind of industry experts to help these women learn. And part of the value of that is that they're learning together. So they can kind of check notes against each other's and reference what everyone's learned, sort of the way that you do in school, instead of trying to learn it all yourself.
Yeah, definitely. I think that's a great point. What you said a little second ago, you said, see how other investors view the property. That's something I kind of did almost by accident, but as I was in my early years of brokerage, every investor I came across, we'd go on a property tour, and I would be asking them like, hey, what do you think about this? How are you going to take it down? What are you going to do? Yeah, exactly what you said. And just learning from them. And I learned a ton just from seeing, because every investor looks at deals pretty differently. Like, of course, there's the numbers, and the numbers have to make sense, but people's criteria are wildly different. So I think that's a great point. Great point. And two, like you said, groups, we talk about that a lot. Mastermind groups or educational groups or whatever you can get into is a great way to get more exposure to commercial real estate.
Yeah. And with regard to the way that different investors think about properties, it took me a while in my career to understand why properties were priced the way they were, essentially, or how somebody could make a 4-cap deal work in today's market. And what I learned is that different investors have different objectives and different requirements, even if it's the same property or the same property type. So something like a life insurance company that's buying properties, they're okay with a 4 or 5% return because that's not their main business. They need something that's producing some cash that's pretty stable. Typically don't use leverage, so the interest rate environment is much less important. Whereas someone that's a more opportunistic investor, their return requirements are much higher, and they're going to have to pay a lot less for the properties than someone else would. So that kind of understanding of who you're competing against and how someone could be competing against you in a way that doesn't make sense for you. Like, you could never pay that price for the property based on your strategy, but based on their strategy, they could. Even in some cases, it's because they see something you don't, that based on your strategy and underwriting, you need to pay this price, but someone else sees a way to create more value than you see. So they can pay a little bit more because they see more upside than you do.
100%. It's funny you say all that, because the last 2 podcast episodes we had, I don't think they could be any more opposite ends of the spectrum. One of them was a triple net investor who does funds and, it's like mailbox money. And then the one after that was a boutique hotel investor. And it's like, that's like hands-on management out the gate. So it's funny. There's just a very broad range in real estate that you can kind of pick what you want to do and pick what you want to go after. And it just depends on what your requirements are. And, your requirements are probably not going to be the same as a life insurance company, but could be somewhere in between. So I think that's a great point.
And they also change depending on what period in your life you are.
Yeah.
When you're younger, you can take more risk. As you get older, you maybe need to scale it back a little bit. And as your portfolio grows, though, too, you can have more different types of investments. So maybe you actually, as you are older, you actually do take more risk, but in a smaller part of your portfolio.
Yeah. 100%. Yeah. So, go ahead, Jesse.
No, I was just going to say, that's an interesting perspective. That's something I hadn't really thought about. I'm young, I'm a go kind of person, and didn't even occur to me until just now that 5 or 6 cap, I could buy that and just retire and be done. And that some people are cool with that, and I'm thinking that's crazy. Why would I do that? But that's just different people. So that's a great point as well.
Yeah. What I was going to ask, Jesse mentioned that you had a podcast or your assistant reach out to us regarding a podcast. What is your objective in going on podcasts? I mean, Yassi and I started this podcast obviously to just grow our audience and hopefully help people, bring them along our journey in investing in real estate, but also kind of get the word out there that what we're doing, what we're trying to buy. I assume it's the same for you, but we do like to touch on kind of personal branding and stuff like that on this podcast. So I'm kind of curious to get your take on what you're doing with podcasting.
Yeah, so similar to you guys, it's about how to communicate what we're doing at Selene Bright House, particularly about that investor education and like what you all are doing, how to help investors that are early on in their real estate journey to find the right options for them. And that, like as we've been discussing, that can mean a really wide range of things depending on who they are and what their circumstances are. So it's an invitation for any of your listeners to come attend our educational sessions as well, and learn about what we're doing at Selene Bright House.
That's awesome. That's really cool. I don't think we've touched on this yet, but what does kind of your current portfolio look like with your firm?
Mm-hmm. So we're just getting started with it. So we haven't acquired any properties. We're in our first year and are kind of in fundraising mode and building relationships at the moment.
Oh, nice. Awesome. Yeah. And prior to that, what kind of property types? I know you said you did a multifamily investments, but was it at any point where you focused on that small bay retail, or is that kind of just you starting your own firm? You decided that's what I want to focus on.
Mm-hmm. So my experience in retail actually primarily comes from the tenant side. So working with various kind of tenants and looking for spaces when I was at Newmark, both alongside brokers who were helping companies expand into other markets and companies that were looking to just change their portfolios. One of the examples is that one of my clients was the Girl Scouts, and we were helping them think about how to kind of bring their organization into the 2020s. They had a lot of camps, and that's kind of typically what we think about it as Boy Scouts or Girl Scouts. But it turned out that most of the Girl Scouts were not going to those camps. That they were too out of the way. They weren't convenient, and to some extent they just weren't interested in that. So one of the projects that we did for Girl Scouts at Newmark was put together what are called the Dream Labs or Experience Centers, and these are centers in strip centers around the country that are kind of have some of what the camps had, but are activity spaces for those Girl Scouts much closer to their houses. So similar to the advantages of other kind of tenants in a strip center. It was largely about convenience and how to bring more girls into those centers and have them more engaged, just because it was so much more convenient. And so I worked with a couple of companies like that were changing or expanding their footprints based on different markets and different objectives around retail, and a lot of that ended up being in these kind of strip centers. But in terms of an investment focus, I've advised some companies and work with them on these, but this will be the first acquisitions that I've made personally in this property type.
That's awesome. That's really cool. Yeah, I think that's kind of circles back to everything we're talking about, that you don't have to initially be the owner, but you've advised people on it, so you know it well, and you know it well enough to go after it and buy it. So with your group, I assume you guys are going to be the GPs and you're going to raise money from LPs. Are you planning on doing syndications? Are you planning on doing a fund, or how are you planning on, the equity portion of the deals?
Mm-hmm. So it'll be a pooled vehicle. So all in a fund.
Nice. Awesome. That's really cool.
Why did you guys choose to do a fund versus syndication per deal?
So a couple of reasons. I mean, not just applying to ours, but any investor that's looking at syndications versus funds. A big benefit of the fund is that you get diversification within one investment vehicle. So instead of a sponsor presenting you with a property that you need to decide, and especially if you're not an experienced or sophisticated investor, you may not really have the tools to decide whether this syndication is the right idea for you. Whereas when you invest in a fund, you're giving a little bit more control to the investment manager. You're relying on their expertise to acquire those properties for the portfolio. So there's maybe a little bit more risk there in terms of giving up control, but you also get the diversification. So you get multiple properties in your portfolio through just one position. So similar to buying into an ETF on the public markets, where you get exposure to maybe the entire market, or at least a large number of individual securities. Anytime you invest in a private fund, it's a similar thing where you're getting exposure to a number of different property types or properties themselves, which helps reduce the risk and the volatility overall, so that you're not so reliant on just one property performing. You actually get exposure to multiple.
Yeah, that's awesome. I've heard a lot of people take that approach. They prefer the fund over like a single asset syndication. But question I have for you, I actually genuinely don't know the answer to this. Can anybody go out and create a fund? I know there's a lot of litigation or maybe that's not the right word, but yeah, there's a lot of legal things you have to set up for a fund. But can anybody do it? Is there like requirement for experience or how does that work?
No, at the moment there's not. There are certain kind of specialized funds that there are. But at the moment, if any of your listeners or you guys or your company wants to set up a fund, you can generally do that without much regulatory barriers. There are some. There's definitely compliance issues that you need to take into account, but you don't technically need a license to be a fund manager. It's basically the same qualifications as if you were a syndicator or other kind of real estate operator. It is a little bit more onerous on the reporting and regulatory requirements, but it's generally available for anyone that thinks that it's something they'd be interested in doing.
Wow, awesome! That's really cool. I didn't know it was that accessible. In my mind, I always just kind of thought, you either need tons and tons of money to set it up with like SEC attorneys or if there might be some kind of stipulations on who can actually open these things.
Mm-hmm. The stipulations are really more on who can invest in them rather than who can start them. Depending on what kind of fund you have, you may be able to accept unaccredited investors, but generally it's limited to accredited investors. So people that are either making over $200,000 a year or have $1 million in net worth are allowed to invest in these funds. And that is one of the disadvantages of private market real estate and investing with a sponsor is that you may not be allowed to, based on SEC rules and depending on how much you make and what your net worth is, which is sort of a catch-22. It's like, well, how do I get $1 million if I'm not allowed to invest?
Yeah.
But it's through some of the ways that we talked about. Like you can do services for real estate companies. You don't have to be an owner right away.
Yeah.
Right.
No, absolutely. Right. And I think the biggest reason too, and you can correct me if I'm wrong, but basically just protect like somebody who's brand new, maybe doesn't know what they're doing from investing into, a fund or something with maybe a bad, because, you hear all right now with interest rates the way they are, everyone's having to refinance, and there's quite a few operators who are going under and maybe shouldn't have jumped into raising money immediately and they're in trouble. So I guess it's to protect the consumer from jumping into a relationship with an operator who maybe isn't quite as experienced.
Absolutely. It's definitely an investor protection issue. And even if you're not able to invest in the private markets, that's also a way that the public markets can really be useful for early stage investors. Is that there's no accreditation requirements for that. Anyone can invest in a publicly traded real estate company in a way that you can't in many private real estate vehicles.
Awesome.
Yeah,
cool.
For sure. Well, Graham, do you have any other questions for him?
No, we covered quite a bit, and I think it was really interesting to get a perspective from somebody like yourself who's gone through, like I said, so many different types of just experiences. Like you have a great resume in the real estate world, so I think it's good to get some insight from that side of things. Most of the time, so far, the people we've had on here, they've had great resumes and stuff, of course, but they're more like, I don't know what the word is. What's the right word for it, Jesse?
Are you looking for like a highly experienced or?
No, not highly experienced, like solo guys, like who are just, who maybe just kind of fell into real estate. It's like you went through the whole education and then worked for a large corporation and just have a very impressive track record. So I think it's great to get the insight from everything you've done.
I appreciate that. I really enjoy this conversation and looking forward to seeing what your firm continues to do as you all grow, and maybe we'll get to talk again.
Yeah, no, absolutely. And for people who are listening, what's the best way for them to connect with you?
So either going to our website at selenebrighthouse.com or my email address is cameron@selenebrighthouse.com.
Okay, awesome.
Yeah.
Well, thank you so much. Thank you everyone for listening to another episode, and we'll see you in the next one.